The major thing that the lenders are looking at is your debt and your income, and also your credit as well as a whole. The higher your income, the more you get approved for. The higher your debt, the further it brings that down. You at least got to try to start paying down your debts as much as you can. If you're looking at your first property, see if you can find something that has a basement suite or an in-law suite. So not only are you going to get approved for more, because we can take that potential rental income and add it to your income, but also you're offsetting your own personal costs. Yeah, you don't realize until you're really in it what can go wrong.
Welcome to the show. Today I am talking to a friend who is a mortgage broker in Halifax, and his name is Richard Abbass. Richard, welcome again. Thank you so much for being here.
Thank you very much. Great pronunciation on the name.
Oh,
First
thank you so
try.
much. Thank you so much. I have one very specific and important question for you. When somebody is trying to buy a house, the first question is, how much house can I afford? Can you help me with that?
Definitely. That's a big question that everyone asks, especially for us mortgage brokers. And it's to break it down as simple as possible to someone that could be a first-time home buyer. It's the major thing that the lenders are looking at is your debt and your income, and also your credit as well as a whole. But there's certain ratio thresholds that you need to meet if you want to get approved for whatever amount it might be. So the higher your income, the more you get approved for. The higher your debt, the further it brings that down. So it's pretty straightforward in that sense. But to any first-time home buyer, that's the big thing. If you can't, say you're in a salaried position and your income's only increasing so much per year, you at least got to try to start paying down your debts as much as you can. I will say the first step would be to though kind of come up with a game plan. It's like chat with a mortgage broker or whoever, someone at your bank, and see where you're at now and see where you want to be. It might involve, maybe it could involve just reducing, the balance on one of your lines of credit or your credit card or your car payment, getting that paid off. Maybe it's your timeline's 2 years, or maybe it's 6 months, or who knows, maybe you're ready now. But I think it's always good to check as early as possible, see where you're at, and then come up with a game plan, because the equation's pretty simple. There's ways that as mortgage brokers we can get a little creative to help you get approved for more. And I'll touch on one of them that I do encourage a lot of people to do is, if you're looking at your first property, see if you can find something that has a basement suite or an in-law suite. So not only are you going to get approved for more, because we can take that potential rental income and add it to your income, but also you're offsetting your own personal costs. You'll be able to save more, and then maybe 3, 4, 5 years down the line, you want to sell that property, or you just want to rent it out fully and buy, your full big massive home that you want to live in for the rest of your life. Then you can do that. But I think it's always a good financial move to start there if you can. I know some people don't want to be landlords, and I get that it's an extra responsibility, but that helps you get approved for more, and it's a pretty smart financial move, I think.
And is there any formula? Because I know every situation is different. My situation, your situation, and Juan's situation is different. But is there any kind of formula that I can find out how much can I afford? For example, if my salary is $50, 50,000 a year,
Yeah.
can I know how much approximately can I afford?
The general rule of thumb is about, you take your annual income before tax, so your gross annual income, and multiply it by 4.5. Now,
4.5.
4.5. That's right. I will say that there's a lot of variability in that, as you mentioned. So it really depends on how much debt you have. So it could be more than 4.5. It could be far less. But that's sort of the general rule of thumb of where you're at. And again, too, it's a lot higher if you're buying something that has an in-law suite in the basement, because you're adding that income. So it can vary, but it's a good proxy if you just want to get a rough idea. Just think it in your own head.
For example, if I have no debt, a good credit score, can I think that I can afford, if I earn 500,000, no, 100,000, no, $50,000 a year, I can be affording up to $250
250,000. Yeah,
probably.
that's probably a reasonable expectation.
And what happened here in Halifax? Because I will not find any property with that price.
I know. Yeah, that situation it's tough. If your budget's 250, it's there's homes out there, like definitely not right in HRM, but if the ways to better that, like let's say you have no debt to knock off, like you said, and you're limited at your salary 50,000, the options you'd be looking at is probably, like I said, was talking about earlier, is getting that where it has that property that has the in-law suite, because that's going to make a big difference. Because other than that, you're pretty limited in what you can do. You can also get a co-signer or a co-applicant, someone that's going to buy with you. That's a large part of what we see is dual income, dual applicants who are buying. So you get 50 and 50, then you're at 100. Changes things a lot.
It was just imagine that I didn't have any debt. Is there any importance of my other payments in my debt, in my lifestyle expenses that I have that increase or decrease the amount of mortgage that I can get?
In that sense, I guess it indirectly, like if we're talking about you have no debts, but your lifestyle is you're just blowing money shopping or whatever, that doesn't directly affect your ratios because it's not factored in your debt to income, which is at the end of the day what caps the amount you can borrow at. But if you stop spending that much on whatever it might be, and you start saving that for the down payment, then you start building up a greater down payment. Obviously, if you're still capped at a $250,000 mortgage, but your down payment goes from $25,000 to you saved up $60,000, then obviously you can purchase a more expensive home. So it indirectly affects it, but your lifestyle choices outside of debt don't directly affect your debt to income ratios.
But what happens if I do have debt?
If you do have debt,
Yes.
then you might go from the five times or 4.5 times to 3.
Oh my God.
Who knows? It depends on how much you have, but that's why a big thing we see that you hear it all the time on financial podcasts and financial newsletters and that sort of thing is the car payment. A lot of people tend to overspend on their car, and then say you have a $500, $600, $700 car payment, it really, really reduces what you can afford because it's such a big payment factor into your monthly debt to income that it can change what you can borrow by quite a bit, more than people would expect at least. So that's one thing I try to warn people before you buy the house you want. Take the crap of your car. Drive the crap of your car for a little bit until you get the house. Get the house first, then maybe start thinking about that.
That's amazing. And that specific mistake is the one that realtors, mortgage brokers, and all professionals in the real estate industry are talking about because it's the most common probably. But what is another common mistake that your clients used to or tend to do when they are trying to get a mortgage?
I'd say like personal mistakes that they're making like before they get to that point. It's other debts too, not realizing the impact that they have on your ability to get approved. Like a big mistake people have is they assume that, like for example, we just said 4.5 times as a general rule of thumb. People just assume that and then they'll go put an offer on a house at 4.5 times their income, but they got a ton of debt, and then they come to you after and say, "Hey, I have an approval. My financing date is in 2 weeks. Let's get me approved." And then you go through it, and maybe you can't get them approved because they didn't get the pre-approval first. That's always step number one. It should be get your pre-approval, see where your budget's at before you make the offer, because there is situations where that comes up. People just think, I have great income, I'm fine. But if you have a ton of debt, it really dampers what you can get approved for. So I'd say that's probably the biggest mistake that you end up seeing is people having expectations of what they can get approved for based solely on income, and forget that there's that second piece there.
So what I can understand here is that even when there is a rule of thumb, is that the name?
Yeah.
I cannot rely on that.
You can't rely on it. That's right.
I should make or run a personalized projection for my spending, for my possibilities. How can I do that?
the best thing is you can definitely lay out your a budget for yourself and whatever you want to do, but if you're really trying to see what you can get approved for is I'm biased in saying this, but go to a mortgage broker. Because, and remember, it's free. You can go to them. I'd be happy to lay out for anyone. It's laying out exactly what you can get approved for based on your current financial situation. Now, there's a little bit of effort that has to go into it on your part, the client's part. You got to fill in an application. You're going to need some documents to support the application. So, tax-related documents, income documents, that sort of thing. But then once you have that full picture, you can go into looking at homes with a little bit more confidence, and you're not just going in on a whim and an expectation.
That is something important because when I have talked to realtors, they used to say that is the first requirement they have. Because people want to buy a house and they say, hey, let's visit some houses, some listings. And they don't want to do that because they said, you need first get a pre-approval. You need first know your budget. And then we can start looking for your dream house. Is that correct?
That is correct, yeah. I know most realtors are pretty good on that because they don't want to waste their own time. They don't want to waste the client's time by looking at properties they can't afford. So that's definitely smart on the realtor side, just to make sure that they're in good hands at least.
Yes, that's important. I hear that, and now I am thinking that previous to come here and to say how much house can I afford, probably I can work on my finances and I can work on my budget and I can work with many things to be ready to buy a house. Is that correct?
Yeah, I think that's kind of a good point too, because going through the pre-approval process, from my experience at least, is it opens clients' eyes a little bit to their own financial situation because they're forced to look at it and evaluate it. Because not like getting approved is one thing, but you also want to make sure once you get approved and you get the mortgage that you can still afford your mortgage and afford whatever lifestyle you have. Maybe you have to cut it back a little bit. Maybe you can't go shopping anymore at Halifax Shopping Center. So I think it's a great practice nonetheless to go through the pre-approval process, even if you're not ready for a year or two, just because it does open your eyes to your own financial situation and kind of forces you to think about, geez, maybe I shouldn't spend that much there or here or whatever it might be.
That is what happened to my friend. She bought her house, and when she did the down payment, the next thought on her mind was, how am I going to pay
the mortgage?
Expenses?
Yeah.
Not only the mortgage, because the mortgage is one expense, one number,
Right.
but then you need to make some renovations, some repairs, many things that you are not considering when you are trying to find how much can you afford.
That's a good point because you don't realize until you're really in it what can go wrong. Like a pipe blows. What do? You got to pay for it. There's no landlord to pay for it anymore, or anything. Little things like that. It's tough too because I feel like that's not talked about as much. The unpredictable nature of expenses that can come up when you're looking at or when you buy a house. I know, when you go through the process of purchasing, you have your inspection and everything, you're made aware of what things could go wrong or should be worked on soon, but there's always the unexpected items that you might have to cover for.
And that is something to consider in your affordability, right?
Yeah.
So
that's a good point. Like when we're talking about putting your entire amount of savings towards the down payment, you kind of got to think about, okay, well, if something happens in the next year to the house, then I need to fix a leak in the roof. Whatever it might be, how am I going to pay that? Do you have reserve savings? Do you have, an emergency line of credit or something like that? That, if something major goes wrong, you're able to make sure it at least gets fixed.
I can see this like a strategy game. So you can plan, you can make a plan, and you can take your best option in order to get your goals done.
That's right. Yeah, there's a lot of different pillars or directions that you have to factor in. You got to make sure it's the home you like. You got to make sure you can get approved. After you get approved, can you afford what's associated with the house and all the day-to-day expenses? Can you afford to adjust your lifestyle now to spend less on whatever you might have been spending money on before? So it's a very big picture purchase that you have to consider because for most people it's the biggest purchase of their life.
That's why it's important to go to a professional, because you may want to have something, but you don't know how to get that, right?
That's right. Yeah, yeah. You can really lay out the game plan of the best move to not only get there but thrive once you're there, and you're not make sure you're not stuck or house poor once you get the house, you get the mortgage and all that. It's you want to make sure you're setting yourself up for success past closing day. That's that. I'm glad you brought that up because that is a huge point that people do kind of they don't think about as much as they probably should because those are important factors that affect
Yes.
your financial situation.
Yes, it's something difficult to think about, but it's necessary, and you need to start at some point. So,
That's right.
what is the best place to reach out to you?
Probably email or phone or my LinkedIn.
Okay.
Yeah. So I don't know. Maybe I can pass it along to you instead of reading it out. But yeah, like I was saying before, not a big social media guy, but you'll see me on LinkedIn.
Okay. Thank you so much for your help, and thank you so much for your knowledge, because this content is very useful for a lot of people who is trying to build some assets here in Canada.
Thanks again. I'm happy to help. I appreciate you having me.
Thank you so much, Richard.
Thank you.